Hi, Charles Sizemore here. So for this week's Investing with Charles, we're going to take a look at what's going on in Florida right now with this sort of ongoing spat with Disney. There's actually a lot to unpack here. There's a lot of applications for other parts of your portfolio, kind of larger questions as to whether political turmoil affects stocks, to what extent it does. Should that affect the way you invest? Should you invest based on your political beliefs? That's a whole nother story as well. We'll unpack a lot of this right now. And I will start by saying I tend to leave my political views, to the extent I even have them anymore, I tend to leave my political views at the door. Whenever I invest, I really try to separate that part of my life. I try to be as objective as possible. Because what I find whenever I insert my own political ideas or ideology, I stop thinking objectively and I start thinking emotionally. And at that point, you've already lost the game. So you see this all over the map, whether it's, if you want to go back to the 80s, blood diamonds, today, energy stocks that are polluting the world, or more recently, the situation with Disney. Once you start demonizing a company, you're no longer looking at the numbers, and you're making investment decisions based on emotion rather than investment merit. So I would encourage you, just in general, let's step back for a minute. Let's forget about all current events right now. And let's just start with the fundamentals of should you engage in what used to be called socially responsible investing? We'll just call it politically charged investing, whether it's coming from the left or coming from the right. Is this something you should do? I would say at the end of the day, you do have to have a conscience. You do have to invest in a way that doesn't make you feel bad or doesn't make you feel guilty. And so to some extent, sure, you do have to vote your conscience, fine. But I would really recommend that you keep that to an absolute minimum and really try to be objective when you look at companies, look at the numbers, look at our stock power rating, for example. We try to be as objective as possible here and really try to leave political causes of the day at the door, because whatever matters to you today, it may not even matter to you next week. And you could have lost a great investment opportunity in the meantime. Or conversely, you could have made an investment that ends up going badly because it fit whatever political narrative you wanted to fit. So whether you're a Republican or a Democrat or an independent or whatever, a communist or fascist, for all I care, whatever your thing is, as a general rule, when you invest, to the greatest extent you can, really try to leave that at the table. Now, so about that, what exactly is going on with Disney, and what are the potential ramifications here? So Florida came out with a law that was fairly controversial, got a lot of press, media play about what can and can't be taught in classrooms. Disney, you really almost have to feel bad for Disney CEO. He wanted no part of this. He did not want Disney to become a political punching bag. He was happy to sell Mickey Mouse ears and make movies and run his theme parks and mind his own business and not put his or anybody else's political views out there. He just wanted to run his company and be left alone. Well, what happened? And that was his original. That was his original course. And what happened was some of his employees got really upset. They felt the law targeted them. They were not at all happy with it, and they were not happy that Disney didn't come out in opposition. And so, you had employee unrest, you had employees walking out, and that was now something that Disney's management had to deal with. Now, the responsibility of a corporation in good old-fashioned Anglo-Saxon capitalism here, what is the purpose of a corporation? Why does it exist? Companies exist to maximize the shareholder value of their investors, of their shareholders. The companies exist to make their owners wealthy. That's the whole point. So, but labor relations are part of that. You can't make your investors wealthy if your employees are walking out. You have to keep your employees happy. You have to keep your employees motivated. Managing your employees and keeping them happy and satisfied and selling those Mickey Mouse ears, that's a big part of creating that shareholder value. And so, Disney does what they do. They end up coming out with some statements against the rules, or against the new law. And then Florida Governor DeSantis came down with a hammer and tried to, successfully lobbied to have some of Disney's preferential tax treatment stripped away. So the whole thing to me does seem a bit silly. I don't know what world we live in where you go after one of your state's largest employers. Whatever the political views are, to me, that just seems like a risky move to go after the people hiring your state citizens. But that's what happened. So Disney's stock price has really been in the doghouse now for a while. And this raises the question, is it because of the situation in Florida, or is there something else going on here? And I can answer that very, very easily. Disney's stock price was already tanking long before this little political scuffle broke out. That was not at all the cause. Now, as the news was breaking, it did accelerate the decline a little bit. But if you look at Disney's, the performance of Disney's shares, and you compare that to, say, Netflix, because Disney and Netflix are direct competitors in the streaming space. Netflix obviously does not run theme parks and does not make theater presented movies or sell Star Wars action figures or anything like that. But they are major competitors in streaming, and both companies were initial beneficiaries of the stay-at-home stock trade, if you will. During the pandemic, stocks that really catered to that staying at home experience really did well. Netflix did well during the pandemic. Disney's was a bit more mixed because, remember, again, Disney is not just streaming. It has all these other businesses that were affected by the pandemic. But these were stocks that have kind of what drove their success in recent years is what's also driving their problems today. The streaming space has become a little bit saturated. It's not growing as quickly as it was. And now that the world's opened up again, the fear on Wall Street is that, okay, this growth story is over. We'll see about that, and we'll talk about that in a minute, but that's what really drove Disney's poor performance. And what the reason the stock is still suffering today. Disney will probably recover about the time Netflix does. The two are really getting beaten up by the same forces. It really has very little to do with this political issue, and let me explain why. There isn't a good estimate out there right now of what Disney's real liability is. In a worst case scenario, the numbers I've seen thrown out is Disney's tax liability at the local level may jump by a couple tens of millions, 10, 20, 30 million, perhaps. Now that sounds like a lot of money, but when you look at Disney, this is a company that does tens and tens and tens of billions of dollars of tens and tens of billions of dollars of revenue every year. If you were to increase their tax bill by 10, 20, 30 million dollars, that's rounding error. It's not going to have any meaningful impact on their earnings. And let's say it did. How hard is it for Disney to just raise the admission tickets another couple bucks? Those prices go up a little every year. They can just raise it a little bit more and no one's going to ever notice. Well, people will notice, but it's not going to stop people from paying. Now, look at sort of the boots on the ground experience. I'm done with Disney. I've already taken my kids twice. I don't want to go to Disney World or Disneyland or any theme park again until I'm old and gray, if ever. But when you have young children, are you really going to let your political views affect whether or not they go to Disneyland? Probably not. And maybe some people do at the margin, but it's not going to be enough to really move the needle. Now, beyond that, Disney has a slew of new movies coming out, mostly comic book stuff, and none of that is likely to be meaningfully affected by any of this political business. It's just not. At the end of the day, it's too small to matter. How do I put this? Kind of more broadly, There's two parts of this. There's one is, kind of consumer backlash, and then there's the direct impact from the government. As a general rule, you really don't have to fear the US government's impact on companies, because the companies, they're taxpayers here themselves, and they're political donors. So if things get a bit too hot for Disney politically, that's when the money machine starts rolling and enough congressmen get paid off to where things go their way. I mean, not to be cynical, but that's how it works. It doesn't work quite as well for foreign companies. So the US government can and does make life very difficult for the companies of unfriendly foreign countries. Think about Russia right now. The sanctions regime has been very effective at really destroying the viability of a lot of Russian businesses. And that's how it is. Like that's that reality. So if you look at other countries, I would be genuinely concerned about the ability of, say, the Chinese government to impact the profitability of American companies doing business in China, because for them, it's not as beneficial to China as it's they feel less pain. If China were to restrict Disney's businesses, their sales in China, that would be bad for Disney. It's not necessarily bad for China. Whereas if the US were to do something, or the state of Florida, any governmental body here in the US were to do something that was too detrimental to Disney, or to whatever, pick a company, Coca-Cola, Bank of America, just pick one out of a hat. It's those are taxpayers in this country. You're not going to do too much to damage them. So again, as a general rule, politicians make their career out of making a scene, out of making a story, out of generating hype. And that's what this looks like to me. It's politicians doing what politicians do, making a lot of noise for their own benefit. It's just not going to make much of a difference to Disney. Now, all of that said, should you go run out and buy Disney right now? Now, I do think Disney's a great company as a long-term holding. You have some of the most valuable brands in the world. It is a great company. However, it doesn't really rate very well on our stock power rating system right now. Based on the latest numbers, Disney rates a pretty abysmal 20 out of 100 there. So that's not, if you're thinking, hey, I'm going to go buy the dip in Disney, well, maybe, but I would say maybe wait before you do. Let's break down those numbers to really give that a look. Disney does rate really high on growth. So even though the last couple of years here have been a disaster for the theme parks and for the movies and for really most of Disney's businesses, because even ESPN, even sports, Disney's businesses really got rocked during the pandemic for very obvious reasons. Even with all of that said, Disney's growth has been very impressive, and the company rates a 78 overall. Now, our growth metric doesn't just look at the last couple of years. It goes back as far as 10 years for some of its sub-metrics. That's what's nice about that model, about that particular factor, is it's not too heavily weighted to the here and now. It weights recent growth, also rates growth going as far back as 10 years, and it gives a blended score based on that. So all that said, Disney has very, very good, strong growth trends backing it. That really hasn't changed. Quality, the stock rates of 56 on quality, I actually think that's probably understated, partly due to pandemic reasons. And the reason is, how do you measure quality? We measure quality by balance sheet strength and by profitability. And Disney's profitability did take a hit over the last couple of years here. So that has the effect of kind of pulling that score down. Now, Disney has some of the most recognized brands in the world, and branding power tends to boost your margins. A Disney movie, it is what it is. It's going to generate a lot more revenue and generate higher margins than a competitor. That's the business they've built up over the last century plus. So I think with the passing of time, as the pandemic disruption kind of gets buried in the data over the next couple of years, I think you are going to see Disney's quality score pop up. Now, from there, it does drop off. Its volatility score is actually quite low at 29. The stock has become increasingly volatile over the last couple of years. COVID was part of that, of course. Value, it also rates quite poorly at 27. Momentum, it rates at 22. And size, this is a large company, it actually rounds down to a 0. So the one I'm really most concerned about is momentum. I don't like to try to catch that falling knife. So even though Disney has really gotten beaten up right now, and if you already have shares, I don't necessarily suggest you sell them. But if you are looking to initiate a new position, I would wait until the stock gives some evidence that it's bottomed out and it started another uptrend. Right now, it's this is a rocky market anyway, and Disney is this is a volatile market, and Disney is volatile within a volatile market. So I would suggest maybe standing back for now, waiting for some sign that the stock has bottomed out first. Now, moving on, I mentioned that politics doesn't really affect stock prices that much. Think of some examples. Think about the great IBM antitrust case. Well, it was a distraction for IBM, and it really did make their life difficult for a while, but it didn't really bury the business, not at all. Microsoft went through something similar, and Microsoft today is in a multi-stock race to be the world's most valuable company. So a multi-trillion-dollar company at this point. The government's actions didn't really slow the company down too much. But if you really want to look at the ultimate political hot potato, the stock that was really, I don't know, the poster boy for kind of getting on the wrong side of the government, look at Altria, formerly Philip Morris. This was the stock. If you would look at a stock chart from, let's say, mid 1990s to early 2000s, there, you can see the stock got utterly hammered in the late 90s. Well, what happened? That's when they had that massive multi-state lawsuit against them that they agreed to. Basically, the states sued Philip Morris for well, you name it. I mean, we all know why. It's cigarettes kill, and they knew that, and they chose to withhold certain information. And anyway, as part of the settlement for the cost of dealing with the effects of tobacco smoking, Philip Morris agreed to just pay out the wazoo to the states, and that really did torpedo the stock price for a short time. You will see that within a very short number of years, that stock was already trading at new all-time highs again. And remember, this is really the gold standard for how badly the government can screw over a company. This was the ultimate punching bag. And even still, Philip Morris, now Altria, was able to recover in just no time at all. Since we're mentioning Altria, why don't we go ahead and take a look at its power stock rating as well? It rates better than Disney. It rates a 57. That's not anything to write home about, but it is above average. Now, digging into the details, you actually do get a better story. The stock rates a 96 on our volatility factor. That's extremely attractive right now, considering the market's in meltdown mode. Investors are flocking to low volatility stocks precisely because they're scared. They don't know where else to go. This is I can't say it's as close to a bond as you're going to get, but this tends to be a counter-cyclical stock that tends to do well when the rest of the market is doing poorly. So no surprise at all, it does rate very well on our volatility factor. It also rates very well on our momentum factor. It rates an 86. Now, you don't normally associate low volatility stocks as having high momentum, but that's the market we're in right now. The market has really struggled this year, and a lot of the growth names have really gotten beaten up badly. So what's done well are these defensive names. So that's not surprising at all to see that. I do think that probably has a bit longer to run. Quality, it rates well as well. It rates a 75. Part of that is there aren't, as the cigarette market continues to consolidate, you do have a high concentration of some of the world's best brands right here with this company, that it's not at all surprising to see that translate into higher margins and a high overall quality factor. Now, from there, of course, it drops off. The stock does not rate well on growth. It's tobacco. It's been a shrinking business for as long as I can remember now. So this will never be a high growth stock ever again, unless they get into a completely different industry, like perhaps legalized marijuana or something. Sure, then anything can happen. Until then, do not expect this stock to ever pop up on a growth filter. Value, it doesn't rate particularly well either. It rates at 30, and size, it rates at 2. So this stock is not, don't go mortgage your house to buy this one. But if you are looking for something to weather the storm here, and this is a nasty market, are we in a bear market? I don't know. It's too early to say, but there is no indications this bout of volatility is slowing up anytime soon. So if you do want something that should weather the storm, a nice low volatility, high dividend stock, then Altria is one to consider. So that's going to wrap it up for the day. We'll pick this up next week.